Good afternoon from OMFIF here in London. It's 1 o'clock in the afternoon UK time. My name is John Nugee and I am a senior advisor here for OMFIF. It gives me great pleasure to welcome everybody remotely to this discussion session on OMFIF's latest report as part of its analysis of international reserves management by central banks. The report entitled Redefining Resilience in Reserves Management. Now, OMFIF is, for those who don't know us, an independent think tank for central banking, economic policy, and public investment. It provides a neutral platform for public and private sector engagement worldwide. We have teams in London and the US, and we focus on global policy and investment themes relating to central banks, sovereign funds, national pension funds, treasuries, and regulators, the official sector, in other words. Within that, we have a focus on global public investors, those charged with managing large pools of public funds. And the global public investors that we identify have investable assets of over $40 trillion, and they are the heart of the financial network of the world. For over 10 years, we have had an annual survey and report, the Global Public Investor Report, which has tracked central bank reserves managers' investment strategies since 2014. In the first edition of the report, we wrote, diversification into different sectors and geographical categories is increasing, owing to suboptimal returns from traditional currencies and instruments in a low interest rate environment. And that was 10 years ago. And over a decade later, this year's Global Public Investor Report shows the appetite for that diversification continues, but for very different reasons. The foundations of the global economic order, underpinned by globalization and the US dollar, are changing. Perception is changing. And reserves management, we think, is changing as well to reflect that. We thought, therefore, it would be worth setting up a small working group earlier this year to engage with a number of central bank reserves managers on their investment strategies and how they were responding to the changing world, the changing geopolitical environment that we find ourselves in. We did this with 10 central banks spread across the world and from varying economic situations. And we did this also with 3 working partners from the private sector, which was BNY, Bridgewater Associates, and Capital Group. And I would like to thank them for their participation and help in running this survey. So during July and August, we conducted bilateral meetings with leading central banks from across the globe, as I say, Europe, Asia, Africa, Latin America. And we discussed what they thought of the macroeconomic environment and how that was being reflected in the way they were running their reserves management. What it meant for their operating models, perhaps also their use of external managers, their asset allocation, currency diversification. And we also included in that what they thought about modern technology, how indeed they were responding to the rapid advances being made by artificial intelligence. The conversations with each institution revealed a system which is shifting, changing. I think that was always the case. I managed reserves 30 years ago, and I could have said the same then. At the same time, it is also anchored in the familiar priorities and objectives of central bank asset management, safety and liquidity, and resilience being the main ones. That's enough from me. I would now like to introduce my OMFIF colleague, Yara Aziz, who was the main author of this report, to summarize the main findings of the report for everyone on the call. Thank you.
Hello, everyone. My name is Yara Aziz, Senior Economist at OMFIF's Economic and Monetary Policy Institute. It's a pleasure to be here with you today to present the key findings of OMFIF's Global Public Investor Working Group 2025 report. Let me start with a quick overview of what this project is. The GPI Working Group is an expansion from our Global Public Investor 2025 report, focusing on some of the key findings from the GPI survey and exploring them in more depth through direct discussions with central banks. For this report, we spoke with 10 central banks from Europe, Latin America, Africa, and Asia, as well as our partners from BNY Mellon, Bridgewater, and Capital Group. The goal wasn't just to collect opinions, but to understand how reserve managers are adapting to today's policy and market challenges, from managing liquidity and risk to integrating technology and ESG considerations. We looked at how geopolitics is reshaping reserve management. Across our conversations, central banks described it as an increasingly inseparable from political and geopolitical risks. The old idea of reserves being purely technical or apolitical no longer holds. What's interesting, though, is that while politics now shape decision making, liquidity still defines the core. Reserve managers spoke about balancing diversification as both a hedge and a political signal, a way to show independence or reduce exposure. But liquidity always wins. Participants spoke of what they called a slow permanent reordering of the global system. The dollar remains the anchor of global reserves and is expected to stay above 50% of total holdings. But that dominance now depends more on liquidity and market depth than on political trust. Several participants mentioned that the US is no longer viewed as the unquestioned anchor of stability it once was. Diversification continues, though cautiously. The euro is still limited by Europe's fragmented fiscal structure and the renminbi by convertibility and market access. And finally, gold has regained importance not just as an asset, but as a symbol of independence and confidence when the global order feels uncertain. While the dollar remains dominant, the euro's role in reserve portfolios continues to face headwinds, and our GPI 2025 survey helps explain why. This chart shows the main factors discouraging central banks from investing in the euro. The biggest concern, cited by almost 60% of respondents, is the expectation of lower relative returns compared to other assets, particularly US Treasuries. That reflects both interest rate differentials and the stronger yield environment in dollar markets. The second set of concerns is structural. The euro area economic outlook, fiscal fragmentation, and the broader political environment. Several participants said that without a true European fiscal union, the euro cannot play the same role as the dollar. Geopolitics also features prominently. For some, the euro has become part of a broader Western bloc, meaning it doesn't necessarily provide diversification from US exposure. In short, most reserve managers see value in holding euros, but they still treat it as a secondary rather than a core reserve currency. If caution defines the approach to the euro, the same applies perhaps even more strongly to the renminbi. This chart shows what's holding central banks from investing more in renminbi. The top concerns are market transparency and the regulatory environment. Around two-thirds of respondents said these issues make it difficult to treat the renminbi as a reliable reserve currency. Geopolitical tensions and capital controls also rank high. Several participants said that while China's bond market is large and yields are attractive, The ability to move money in and out remains unpredictable. A few reserve managers mentioned that even their trade with China is still invoiced mostly in dollars, which limits the practical use of the renminbi. Now, if geopolitics shape where reserves are held, the basic principles of how they are managed have barely changed. So while the tools and the markets may evolve, the hierarchy that defines reserve management still holds. Safety and liquidity come first. Most policymakers said they measure success by how ready they are to act in a crisis, not by how much return they earn in stable times. The GPI 2025 survey backs that up. Capital preservation is still the top objective. On this chart, the dark blue slice shows 61% naming capital preservation as their main goal. The light blue slice is 29% for liquidity, and only 4% in green cite target return. This reinforces what came through strongly in our calls. Even in a higher yield environment, reserve managers remain focused on resilience and not performance. So while capital preservation remains the foundation, many reserve managers are also looking ahead and thinking about strengthening that foundation through diversification and by gradually building up their reserves. Diversification has become a central theme for policymakers navigating uncertainty. Many are fine-tuning portfolios through ETFs or selective use of investment-grade corporates, focusing on flexibility rather than taking on more risk. Digital assets, meanwhile, remain on the sidelines and not adopted yet. This chart captures several messages from both the survey and our discussions. Nearly 60% of respondents in the top bar plan to adjust their diversification strategies, making it the main area of change. Next is the size of reserves. More than half of central banks expect to keep building buffers and treating reserves adequacy less as a fixed benchmark and more as a living test that shifts with conditions. ESG integration follows a similar pattern: gradual, cautious, and mandate-driven. Institutions are aligning it with policy goals, but never at the expense of safety and liquidity. And finally, while liquidity appears lower on the list, it remains a quiet foundation and the ultimate measure for readiness when shocks hit. Now, it's worth looking more closely on ESG because while the integration trend is clear, progress is uneven and it varies a lot across regions. This chart highlights how uneven ESG integration remains among regions. The dark blue bars represent central banks that do integrate ESG into their portfolios, while the light blue bars show those that don't. Europe is clearly leading, where 81% of central banks report integrating ESG factors into their portfolios. In contrast, integration is low elsewhere, particularly in North America and parts of Africa and Latin America. From our conversations, this isn't due to lack of interest, but rather structural constraints. Some reserve managers told us their mandates don't yet allow for ESG, while others cited inconsistent standards or data gaps that make implementation difficult. Among those applying ESG, the approach tends to be pragmatic. It seems less as a separate goal and more as part of a broader effort to manage risk and strengthen resilience. Beyond sustainability, another major theme came through strongly this year is technology. This was one of the most forward-looking parts of the discussions. Many central banks are starting to use AI tools for areas like data automation, portfolio monitoring, and early warning indicators in risk management. A few are developing these systems internally to maintain confidentiality and control, while others are taking a slower route, looking for training and support to build confidence. We also heard strong interest in regional cooperation. Central banks that are still in the early stages of integrating AI spoke about the value of sharing knowledge and technical expertise across regions by learning from peers rather than starting from scratch. Despite these differences, every policymaker we spoke to emphasized one point: decisions must remain with people. AI can enhance analysis, but human judgment is still the ultimate safeguard. The other recurring issue was cybersecurity and governance. As digital systems expand, so do the risks. Institutions are aware that a cyber incident today isn't just operational, it can be political very quickly. So technology is not replacing human expertise, it's amplifying it, but only if the right governance is in place. Now, if we look beyond AI specifically, the broader digital landscape shows a similar pattern of early exploration rather than full integration. This chart captures how central banks are approaching digital transformation more broadly. You can see that data services, cloud systems, and encryption are the most widely adopted technologies. When it comes to AI, most institutions are still in the exploratory phase. Very few are content with their current use, shown in the dark blue bars, while a much larger share in the purple and green segments show they are either not using AI yet or only beginning to explore it. This aligns closely with what we heard in the working group calls: strong interest but very cautious implementation. The light blue bars are worth noting too. They represent institutions that already have some systems in place and are now looking to upgrade them. It's a sign of gradual, deliberate progress rather than rapid change. Technologies like blockchain and other experimental tools remain at the margins for now, reflecting the sector's conservative risk culture. So overall, digital adoption is moving forward but carefully. Central banks are building the foundations first: data quality, security, and governance before scaling up to more complex systems like AI. So, what do all these trends actually mean in practice for reserve managers? What's clear from all these discussions is that reserve management is being redefined by politics, technology, and uncertainty. The environment has changed, and central banks are adjusting not through major moves, but through steady adaptation. The hierarchy of safety and liquidity still holds, but how those priorities are managed is evolving. The dollar remains dominant because it offers far greater market depth than its competitors, yet confidence in the US has weakened. Many institutions now see it as just another source of risk they have to manage. Technology is becoming part of how central banks think about stability. It's no longer an operational add on, it's shaping how they assess risks and build systems. Data capability, cybersecurity, and automation are all becoming part of resilience itself. And finally, regional cooperation and shared learning are gaining importance. Many reserve managers are looking to peers and regional networks to exchange knowledge, share resources, and build capacity where domestic constraints are tight. Taken together, these trends point to a more cautious but also more connected future for reserve management, one defined not just by the size of reserves, but by the strength of the systems and relationships that supports them. To wrap up, thank you all for your attention. This concludes my presentation. You can download the full report by scanning the QR code on the screen for additional insights and deeper analysis. Now, I'll hand it over to begin the panel discussion, where we'll dive deeper into some of the key findings.
Welcome back, everyone, and I hope you found that report on our report, if I can put it that way, interesting. I should mention that the report is available from OMFIF in electronic form. If anybody hasn't already seen it and would like a copy, it's only about 35 pages, so it's not a complex read, but I think it's a very meaningful one. It's a very neatly summarized report. Now, for the next hour or so in front of us, we are going to discuss this report and its findings and our thoughts on it. And I'm joined on a panel by five people who I hope are now all on your screen. Let me please introduce them. Starting with Andres Cabrales, Director of International Investments Department at Banco de la República Colombia. Welcome, Andres. Guillaume de Croc, Deputy Head of Asset Management and FX Reserves at the Banque de France. You can all tell I'm English because I can't pronounce anybody else's language. I apologize. Guillaume, our representative from one of our two representatives from the Eurozone here, so a different perspective on reserves management from the Banque de France because you don't have a domestic currency, you are part of the euro, but you are also welcome. From the Bank of Uganda, I'm delighted to have Patricia Gulyatonda, Head of Domestic Market Research and Analytics, bringing us, I think, a really interesting perspective, a different perspective from Africa. From Österreichische Nationalbank, the Austrian Central Bank, Günther Herbel, Head of Risk Management. And we should not forget that risk management is an important part of asset management, important part of reserves management. Günther, our second representative from the Eurozone. And representing the private sector in all its glory, Adriana Pirelli, Regional Executive and Senior Executive of Client Management at BNY. And it gives me an opportunity, Adriana, to thank you once again for BNY's contribution, major contribution to this report. Now, we're going to look through this report under a number of subject headings. And the first one, and the one which has caught, I think, possibly the most attention, is the status of reserve currencies. And in particular, central bank attitudes to the dollar as the reserve currency of the global financial system, and more importantly, I think in some cases, the fundamental provider of liquidity, the US fixed income markets, the treasury market. That's something which has been part of reserves management for all of anybody on this call's lifetimes. I think I'm the oldest, but even I was born after the Second World War. And since the Second World War, it has been axiomatic that the dollar is the reserves currency of the world, the leading currency of the world. The treasury market is the leading market. And for the first time in this report, we are beginning to see signs that central banks are reconsidering that. And I wonder if I could turn to our central bank panelists in particular to explain how they're thinking, what they have extracted from the report about what their fellow central banks are thinking and why we think that is. Guillaume, would you like perhaps to start on this one?
Definitely, so happy to take the opportunity to give my a few ideas about it. So as all I would say is that the US dollar is still key in the financial markets. So there's no wonder about that. But if you look at the past, definitely the trend towards diversification away from the US dollar has been there, very gradually, very slow, but still there, still the early 2000, I would say. So this is something happening. So this is not new, but definitely today with so we've been through many financial shocks, right? And still the current environment is still bearish, right? So and it's all about geopolitics, as you show in your report, and the expected move from the central banks who really look for safety in this environment. And traditionally, the US dollar is really a good asset for that purpose. But today, it is, I would say, this is the zeitgeist. It is this aspect is quite a question about the US dollar. Is it really a good thing today to invest in this currency? So this is, I find it quite interesting for us to do that. Definitely, diversification is key, but the candidates are not that many, I would say. as you mentioned in your report.
Thank you very much. You've highlighted one very important element of a reserve currency, which is that it keeps its value. There's a second element of a reserve currency, which is the depth of its capital markets. It is quite possible for a reserve currency to keep its value, but not have sufficient markets. And I wonder, Gunther, here's an opportunity to turn to you as the other Eurozone representative. One of the things which stands out from the report is the mixed attitude towards the euro and euro capital markets. When the euro was introduced 25 years ago, it was widely both seen and I think hoped to be an alternative reserve currency for the world.
Absolutely. And of course, the US dollar is still the most important currency in the world. And I think Guillaume said it quite clear. It is the largest share, it is the most liquid part. But during this year, we have seen two events, and especially from a risk perspective, they were quite interesting. Once in April with the market reaction towards the tariffs, and then in September, October, the longest shutdown in history of the US government. The first one in April has a big market reaction, and you could see there was moving something. The second one in September had none such impact on the markets. It was more seen as a political thing. But of course, safety is not a given. And maybe that's the time for Europe and for the euro to be seen as more attractive relative to the others. Because what I heard over the years always was Europe is hard to understand. It's quite complex. There's so much difference between the member states and things like that. And maybe now, of course, there is the dollar still the dominant force, but they are also getting more complex with the situation emerging there, and that the realization of everyone that safety is not a given, and it doesn't look like that the next decade will be the same as the last one, and maybe that's a point of opportunity for Europe.
Thank you. Andres, you have a slightly different perspective, of course, because the American hemisphere is very naturally more focused on, and I won't say dependent on, but reactive to events from your neighbor to the north. Your perspective.
Thank you, John. I just wanted to point out that thank you and thank OMFIF for the invitation, and also point out that my views here today reflect mine and not necessarily those of the Central Bank of Colombia. Yes, so that's a good point. In terms of the Americas, given our close geographic, commercial, and financial relationship with the US, it makes sense for a mandate to have a high allocation in dollars. And if you look at reserves by geographic regions, our region tends to be more focused on the US dollar. So having said that, it's an important asset class for us. It's the most liquid, the largest in the world for fixed income. So it's a benefit that we have. Having said that, we found that the results from the survey were refreshing in a sense that it reflects our mindset as well. In terms of looking for diversification within our portfolio, it makes sense to be exposed to other risk factors and not have an over-reliance on the US dollar. So we've done that. We've been one of the central banks that have actually looked for diversification. We want to respect our mandate, so the diversification that we have done so far in other currencies is done within our mindset in terms of achieving the goals that we want with our portfolio. So we've been able to balance that. So we're not looking for diversification just per se. We want to have it if it makes sense financially and being exposed to other regions in the world while keeping our objective clear.
I think that's very interesting. One of the things which came out of the interviews and that we were conducting was that although people still believe in the US dollar, believe in particularly the depth and liquidity of treasury markets, that belief is now, as it were, afterthought rather than automatic. Had we asked this question 5, 10, 15 years ago, I think people would have automatically seen the dollar as the premier reserves currency. It's now seen as the best that there is. There isn't yet a single rival. Even talking to Asian central banks, Andreas, you were saying in the American hemisphere, you naturally have a different perspective on what in the Asian central banks we talked to were those who mentioned most the rise of, for example, investments in renminbi. And maybe from this, we're seeing a regionalization of attitudes among central banks rather than an automatic assumption that the dollar is the best currency wherever you are in the world and whatever your relationships. Patricia, I don't know how you see it from Africa. Do you have a different perspective there? Because you are, as it were, able to choose all the currencies.
Thank you, John. And I like what Andrea said. It's not diversification just for the sake. We think of diversification very much in line with asset liability matching, which is the priority when we do our reserves management. And we are looking to see how closely are we matched to meet our liabilities. So in doing that, the risk that we could find with diversification just for the sake is taking on exposures that could cost you money should they turn around and you're not able to fund in these currencies. So in this way, we've found ourselves still very attracted to the dollar, mindful of the need for diversification and indeed going that way, but through other asset classes, not necessarily other currencies. What we've found interesting though, in the recent years, we have grown our Euro book on account of growing liabilities in the euro, and we've seen that grow as well. But you find that we are not able to take expressive views to the same extent because of the complexities that have been mentioned in the euro market. It's still a bit complex. You are exposed to so many other countries which may not be clearly understood in your composition of portfolio reserves, and then you find the effects are playing off each other in a not so positive way. So we still find a lot of interest in the dollar, but also looking to grow a lot of our other sectors as well as asset classes such as gold. Thank you.
Thank you very much. And I'd like to come back to gold in a moment, Patricia, because that's actually a really interesting topic worthy of a discussion on its own. So if I can hold that and come back to you in a moment. But staying with the choice of currency, there was one central bank on our panel of interviews who said to me, it's not just about the market and whether it's able to provide. It's also about the host central bank and whether it's willing to. And I think we should all recognize that the Federal Reserve in recent crises has really gone out of its way to facilitate helping other central banks. And I heard this central bank say to me, I would love to feel that is still the case. And we can't straight global politics and attitudes of different administrations here. But confidence in the dollar is also inherently confidence in the treasury market, of course, but it's also confidence in the Federal Reserve. And I don't know if Andreas or you have any comment on that, or if anybody would like to reflect. Adriana, do you have a view on how your clients are reacting to changing political sentiments?
Yeah, so we clearly are very interested in seeing how our clients are looking at their positions in dollars and in global markets. So we have in custody around 58 trillion. That represents 20% of the investable assets in the world, more or less. So our view represents the 20%, right? And we were expecting to see more of an outflow potentially from the dollar in the last 12 months, or let's say in the last 12 months. What we have seen is more hedges being created in April, particularly 6% over the normal kind of levels. So people have certainly taken a position just thinking about hedging, but not exiting their investments in dollars. If anything, they've invested more, of course, not central banks. This is the totality of our clients in equities, but also the positions in longer dated treasuries have not really changed. So it's actually interesting that, yes, there is a lot of attention on the markets of what's happening. We've not seen until now much of a change in the activities of our clients on an aggregate basis, if not in relation to the FX hedges that have been put on their portfolio, and of course the effects on their positions overall. But if you take that out, not much of a change so far.
That I think is very interesting. It mirrors what the central banks on our call are saying, that thought is being given, but action is not yet being taken. And I think that's a good way to summarize what for me the report was saying. For the first time, people are thinking, and that's the first stage of action, but they haven't yet got to the stage of action. One of the reasons I mentioned the role of the host central bank is because, of course, all currencies have a host central bank, but not all assets. And Patricia, you were mentioning to us before the call the very interesting approach that the Bank of Uganda is having to gold, an asset which is nobody's liability.
Indeed, yes. And just like you rightly mentioned, the recent rise in geopolitical tensions has brought to light the risks in holding these fiat currencies, and because they are hosted by central banks, and it is actually the property of the host central bank. And we have started to think very actively and to take proactive steps to build our gold reserves. But maybe just a little background. So in 2021, when we saw extreme inflation, the inflation went aggressive in all the markets, coming out of zeros through the COVID season. We saw significant capital flight out of our markets, and that meant offshores probably selling investments and looking to exit because they were positioning for aggressive rate hikes in the advanced markets. Not only were they exiting, but because the local currency was depreciating, then debt was becoming more expensive. And we had to critically think of ways to build reserves. Traditionally, our central bank has built reserves from purchases in the domestic market, but you can imagine how that would become constrained in an environment like that. And that is how we birthed the domestic gold purchase program, which intends to buy gold that is domestically mined in local currency and use it to build our reserves, but also to generate diversification away from the traditional assets. So this is how we started our journey, and we are in the final stages, scheduled to do our first purchase by early next year.
So fascinating. You are buying domestically mined gold from domestic producers with domestic currency, but then adding them to the reserves. And in this way, you're not intervening on the foreign exchange reserves, of foreign exchange markets.
Well, we haven't intervened on our foreign exchange market on the sell side for the last 3-4 years. We haven't done that. We have built significant volumes of reserves from purchasing FX in the domestic market when conditions allow. And if conditions are still supportive, why not? But in this way, our central source of FX will then be gold. Yes.
Very interesting. You join then, I think, the main holders of gold among central banks, other than other producers, are the European central banks. And Gunther, thinking that's largely historical, isn't it? I mean, the European central banks as a whole, obviously a longer history and reaching back into a time when gold was more important. But the Euro system as a whole, if you take all of your fellow national central banks, substantial gold holdings.
Absolutely. So gold is, I think, the oldest form of reserve currency, so to say. It existed over decades and it changed its role, of course. Unfortunately, we're not in that lucky position as Patricia and Uganda. We don't have gold mines, at least not very productive ones. But for centuries, we really keep our gold, and we also realize every day right now with the price increase even more, in public opinion, it's very, very important to have this gold and to see it. It's still there. It's in the vault. So it gives a lot of security to the people. Therefore, it's a part of our resilience. We don't buy or sell it right now. And I think in the near-term future, it will not change. But to have this gold as a form of a backstop for any crisis for the long term, it's really important for public opinion.
Thank you. I mean, that was one of the things which came out of the report, that people saying, central banks saying, gold is not just a financial asset. It is, how shall I put it? It's a social asset. It's an emotional asset for the people. It's, interestingly, probably the part of the reserves that the general public understand best. And Guillaume, I don't know how that plays in France, but certainly in the United Kingdom, when we sold some gold, nobody has ever really forgotten or forgiven the government for doing that. It becomes a highly political asset.
Definitely, it's highly political, and so we treat it at Banque de France like a legacy asset. So we don't want to stay at, we don't want to buy or sell at the moment. This is not this is out of the question, even if the move is quite dramatic there on that market. So it's hard to ignore, but definitely it's a good candidate for safety and what central banks are looking for. So, and actually, France is quite a very small producer, but we don't have gold in our vaults.
Certainly, there are other European countries which are actually have a gold purchase problem. You're saying that you treat it as something, as a legacy asset that you have, and I suspect you're quite pleased to have at the moment.
Definitely,
But,
please.
It's an interesting asset because it's only of use when you sell it, really. Andres, gold in the New World has had a completely different meaning, of course.
Yes, and I'd say that in our case, we haven't been very active recently. We actually include gold within our asset allocations whenever we design it. And as you might guess, given our the way we hold our accounting and we have it via mark to market, and being most of our allocation in fixed income, gold is a very volatile asset class. So whenever we look at our strategic asset allocation, it's gonna assign a low percentage to gold, given that we still favor, as you mentioned at the beginning, John, safety as the most important characteristic of our reserves, and we try to avoid losses within a 1-year horizon. So a high allocation to gold would unfortunately give us a high probability of loss given the volatility that it has. So given that and our framework and the fact that we look for safety as a priority, the allocation that we have is very small. And we haven't been active in that sort of way. But I agree with the point mentioned in the panel that I think the public would like a larger percentage because it's the asset class that they normally identify their national reserves with.
Patricia, I don't know how the Ugandan public view gold.
That's interesting. The Ugandan public is very excited for the central bank to hold gold. And actually, they've been asking, why did it take us this long? Because when you look at our balance of payments, gold exports have been growing steadily over the past 4 years. So yes, it's very exciting for the public. And we are mindful of the volatility of gold as reserve managers. And that is a key concern. We don't want the reserves to be so volatile. So what we are looking at are several options. One, like you said, gold is very useful when you sell it for the hard currency. So that's an option as well, right? And when we design our SAA, we may choose to include a small portion of gold, but that doesn't mean that that would limit the central bank, because you have the option to hold gold as stock and transfer it to your reserves as and when you deem the right time or appropriate. Yeah, that is how we're looking at that.
Adriana, it's perhaps not a fair question to you because I didn't pre-warn you, but do you have any views from the other side on gold, or is it not part of your modus operandi?
So it's definitely not in our modus operandi, but we do see increased interest from our clients indirectly through ETFs investing in gold. So we see it from that perspective, and it's interesting to see how it, the perception of the public, institutional even, because we see it as a B2B2C model, but we certainly see enhanced interest.
It's a strange instrument. The more expensive it gets, the more people want to buy it.
Correct.
Can I take us from gold, and it's not much of a step, to the general question of asset allocation completely? Because one of the things which came out of the report was that the difference between reserves management and wealth management. And talking to central banks, their asset allocation and their objectives remain, I think, to me, the thing which came out of the report is how traditional they were. And how you could have talked to reserves managers 10 years ago, 20 years ago, 30 years ago, 40 years ago, and the trilogy of objectives, security first, liquidity second, after that, considerations of enhanced return. It still seems to hold. Guillaume, do you want to have a view on this? We seem to be consistent in this at least.
So definitely, but just so I can remind us of the recent past. So when rates were close to zero, we really had to search for some return even at our central bank. So diversification was still an issue at some point to get some return. So we're not insensitive to this need, but definitely today with higher returns, there is less need for diversification, and govies, as a rule, is quite a good candidate for our investment universe. So, and it was the case 10 years before.
Andres, the same for Colombia as well, perhaps?
Yes, I would simply point out that I think that the memories from 22 still are in the back of our minds. So in our case, it's been a good year, and the past few years have been good. But going forward, I think that if we ever get to low level of rates again, we want to have a diversified portfolio. So it makes sense to do that now. And we've also looked at other alternatives in terms of maybe having more active management, setting up a securities lending program that add on to the return that we might have on our reserves. So we're looking for other sources that might help us when we are in another scenario with lower returns. So working on that as well.
So you're continuing the pursuit of returns, but I sense having met the primary objectives of security and liquidity.
Indeed, yes. Everything within the framework of looking for liquidity and security first, yes.
And Gunther, if I can turn to you, is that how you read the report as well? I mean, we're looking at a wide range of central banks across the globe, and there seems to be, on this subject at least, still a degree of unanimity.
Well, in general, I would say yes, because safety is, of course, very important for central banks. But what might differ a bit within the Eurozone, of course, we don't have any FX targets, and we don't use our reserves to control the economy or use it on a daily basis. Therefore, it's more stable over time, and we have more options to manage it and also to encourage a bit to have a return. So I would frame it more as a trade-off between risk and safety. Return and safety. The traditional risk return is important, and it has to be solved. And I learned a lot from other central banks and discussing also outside the Eurozone, but especially inside. Risk appetite statement is now the place to be, and most of the central banks have such a risk appetite framework in place where they discuss exactly this trade-off between what do we want to achieve, how does it, what effect does it have on risk in traditional terms, so on volatility, on value at risk, or things like that, but also, and that's also very important, on the reputation side, because of course our most important asset as a central bank is the reputation, and we have to keep it.
That I think is really interesting observation, particularly the fact that viewed from Vienna, you know, somebody else is looking after your currency. Shall I just put it that way? So there is a different nuance, and what comes out from me from this report is that even so, the majority of central banks still tier the three objectives. So that security is the most important objective. Once you've met that, liquidity is the second most important objective, and you pursue that. And only having satisfied those two, do central banks turn to the pursuit of extra return. And you're saying that this risk management is there's a nuance to it if you're in the Eurozone, but it still largely holds.
Yes, safety is king. What is safety is much more complex compared to others, I think.
Guillaume, do you have a view here?
So just another concern that definitely we used to be invested in a AAA area. So today it's no longer really exists. So definitely the absolute safety is a bit lower, but we still value it, and we want, in relative terms, the safest assets.
And here I think we do detect a difference looking further from this working group report into the full global public investor report that OMFIF does annually. Those central banks which are basically managing very large reserves, as I said earlier in the call, reserves which include elements of national wealth, there is more nuance. There is more compromise. There is more trade-off between security and return. For the central banks, though, who are managing what are still orthodox policy reserves, the tiering, the hierarchy still holds.
Frankly, it does. No. I would say that the risk appetite is still limited, and the framework is quite conservative. Because traditional finance will recommend to diversify in equities and other kind of assets. It's definitely not the mandate of the central bank, according to.
And this leads into one other thing which came out of the report, which is the attitude of central banks towards things like ESG. A central bank reserves management operation which tiers its objectives. First, security; second, liquidity; third, return. It seems to me, coming out of the report, that ESG, if it's included at all, is a fourth tier. So it's very much, I won't say an afterthought, but a subsidiary objective. I don't know how you react to that. Patricia, do you have an ESG policy at the Bank of Uganda?
Yes, the Bank of Uganda is very passionate about ESG. Actually, we are currently pursuing certification from the SSCI for sustainable operations as a central bank. So in that way, we are very keen on sustainability. When it comes to reserves management, though, we are still very much similar to that central bank that said it is still safety and then liquidity, return, and then ESG. We are still very much there, but how we are thinking of ESG, we want to leverage the points about ESG that enforce safety, liquidity, and return. So for instance, if you were doing your risk management or your analysis of your counterparts or your fund managers, what exposures do they have to ESG factors that improve or highlight what you should be looking at when you evaluate them. So in that way, we are keen on ESG, but we haven't gone as bold as other central banks to have ESG form part of the core objectives of reserves management. Yeah.
I think we were talking earlier about where the report highlighted a wide degree of consensus among central banks. I think this is one area which shows very varied approaches by central banks. Some central banks are fairly direct in saying that it's not their responsibility. Their responsibility is monetary stability. Other central banks, like the Bank of Uganda, place a higher proportion on it, a higher priority on it. Andres, do you have a view on how the report shows this variation, this wide variety of opinions? One area where it did.
Yes, I think that the report pretty much reflected the two camps that exist nowadays. I think most central banks take it into consideration. Some consider it a fourth pillar. We are more in the camp of the Bank of Uganda as well, in terms of it's an important thing, but it's still not up to the level of our pillars. We see it as a very important way of if you take it into consideration of controlling the quality and the risk of the issuers that you buy, given that there's some exposure to those factors that might hurt them. But we've been slower than Europe or other regions in accommodating this, and we're expecting the market to mature a bit more. We consider it still at a young phase. We want scores to be more consistent amongst themselves, and the market to be more stable in order to take further measures. But we've been walking in that direction as well.
Adriana, if I can turn to you, because you will have a greater view of a wider range of investors. Are central banks typical in their response to ESG? Does the report surprise you in the variety of their responses, or do they stand out on a limb?
No, it doesn't. I mean, I see varied responses both by regions. So certain regions are more keen and focused on ESG than others in general. There is also an element of the data quality that plays a big part in this consideration, because to the extent that you can really rely on the data quality, and it's easier on the equity side than on the government bond side, right? There is an element there of how do you ensure that you're taking certain elements into account in your portfolio to make decisions. So I think there is an element of maturing of the discussion, but also how much is this a risk management consideration? And there I see much more a point of evaluation of every central bank or sovereign wealth funds versus value-based. I think it's less value-based, definitely much more considered from a risk management point of view.
Gunther, if I can turn to you, you obviously have a greater insight on the risk management side. ESG is not often these days seen as a returns enhancer. The period when people thought that ESG assets would perform better is perhaps in the past. Is it a risk diversifier?
To some extent, it might be, but I'm with you. Many changes we have seen have happened in the past, where some transformation took place in the market and some repricing. I think to a large extent, the most important thing are now integrated. We have fully understood it. We mention it. We have a disclosure report with several key ratios we disclose every year. I think we have a basic understanding on where are the physical risk, where are the transition risk within our portfolio. This doesn't change completely our view on the asset allocation. I think that's very important, because we discussed in the beginning, US Treasury is very important, and that's still true even after ESG consideration. You can't rule it out, you can't replace it. And of course, for government bond, which is still the most important asset class for central bank, ESG is quite very difficult to handle, because it's a residuum. It's not the driving force. The driving force for climate change is happening within the corporations and with all the action that takes place on innovation and so on. And therefore, it's not something that can be easily controlled by reserve managers.
I think that's very valid, and I think probably the takeaway for me from this is that it may be more the wealth management side of public investment, the national sovereign wealth funds, for example, where this might be something that can play more, because it's hard to have ESG policies on a US Treasury portfolio.
Exactly. Even 10 years after the Paris Agreement, yeah.
Well, we've just finished COP30 in Brazil. Now, Andres, that was very close to you. How does it change your view at all? That's not really a fair question, but please answer.
No, I think it does, in a sense that it brings these topics closer to home, and you have to agree that when this leads a central bank to think strongly about these issues, so it does help a lot. And I've said that the past few years our steps have been stronger in this regard. So it does definitely.
Thank you. I'm going to switch the subject very slightly, in fact, quite a lot. If we were a group of equity investors, the one subject we would spend most time talking about is AI. Clearly, the driving force in equity markets, particularly the US equity market at the moment. Many would say it's the driving force in the global economy. What came out from the report were two interesting things. Firstly, the degree of attention that central banks are paying to AI. Even central banks have to take it into account. But secondly, the variation in their responses to it. Reading through the report, it appears to be a subject which central banks are beginning to get to grips with, struggling to work out how to incorporate in reserves management. Guillaume, do you have an AI policy? Can you give concrete examples of how you're using AI?
So frankly, and it's quite, I guess it's the overview is quite relevant in the report. There is quite a will to integrate it more, but it's not. It's not dedicated to reserve management just in your daily professional life. So this is it from as a user. So definitely there are some many work in progress, but it's only for now some experiments, I would say. So only the beginning, quite hard to see where it will lead, but definitely promising.
Patricia, do you have a view? Were you surprised with the attention paid to AI in the report? If we'd run this report 3 years ago, I doubt it would even have got a mention.
Was I surprised? No, but I was comforted because most central banks are thinking about AI the same way we are. We are not there yet. We are aware it exists. We like it, and we use it for simple tasks. But for us, AI must be used in the same sentence as cyber risk. So we are thinking, where is the governance structure? So we need to put that in place, and I believe that work is underway. Reinforce the cybersecurity management structure, and then come back to the AI table with some comfort. So I was amused because, like you said, 3 years ago, no one really cared. It was mostly for private sector, but we can't run away from it anymore. Although, just like as traditional as central banks have always been, we are not too quick. And I agree that Bank of Uganda is also not trying to take leaps on that front. Yeah.
Gunther, do you have a perspective on, first of all, the report and what you read in it about AI? And secondly, how are you personally thinking about it? As I say, 3 years ago, we would not have had the discussion. Maybe in 3 years' time, if we held this discussion in 3 years' time, it would be so integral to everybody's work that, again, we wouldn't have the discussion. We might just as well talk about, do you use electricity?
Absolutely. No, a couple of years ago, of course, we had some experiments and sandbox approaches to machine learning and things like that. But the big shift, the big disruption was, of course, the LLM models with ChatGPT, I think 3 years ago now. And markets doing probably much faster than central banks. And I fully agree with that. But I think there are two reasons for it. One is, of course, safety. We want to make sure that the operation really works. So it's not just try and error. That's something central banks typically don't do. And the other thing, central banks have a broad diversity of tasks. So compared to any commercial banks, we don't have 1,000 branches, 10,000 salespeople, and they do all the same. We have quite a limited amount of people who do very different and very specific tasks. Therefore, it's much more difficult to apply AI to this very, very complex and specific environment. But of course, we're doing a lot. And I think in 3 years, a lot of things will change, of course.
Do you have any concrete, does anyone on the panel have any concrete actual uses of AI, or is it still in the investigation and learning stage for you?
Well, I would say on productivity, we're doing a lot to summarize things, as the report says, data analysis, error detection, things like that. That's going on for a while. But the big thing, just to fully have AI focused processes with some human interaction only, is still in the making or in the planning, not in real.
Andres.
John, yes, I will point out that I agree with Gunther in terms that given our conservative nature, we've been slower than maybe the private sector in adopting this. In our case, and maybe what the survey also reflected is we've used it for operational tasks to optimize our process, but still the big decisions are still decided by the staff and not AI.
I think that's common with all the central banks we talk to on the report, and I suspect wider than that too. AI is used for data management, data analysis, not yet, I think, in most central banks for decision making. Portfolio construction, asset allocation is still seen as something which requires human, not so much oversight, but human control. Adriana, does that chime with your bigger private sector clients, or are they more innovative and imaginative in their use of AI?
So this is actually an interesting one. We have probably gone further than many of our clients in leveraging AI at BNY, and this is coming straight from the top. So for us, is AI for everyone, for everything, everywhere. And the focus has been on ensuring that all our colleagues are well-versed as much as you can start from, people who are not technical experts, but just understand AI enough to be able to leverage it responsibly with all the controls that are required in this type of conversation, because that is the critical component of what we're talking about. So we have 99% of our staff who's trained on AI from an ethical point of view. We have 50% of the staff that's using it on a weekly basis, and 20% that's using it, 30% at this point, that's using it daily. 20% have also created their own agent with very specific boundaries on what this entails and controls on what this entails. We also have 100 more or less digital employees who report into an individual, obviously doing mundane tasks, right? But the element is we are expanding on the capabilities that we are putting at disposal of the structure in order to be able to be more for our clients, and being an infrastructure of capital markets. That's what we are doing. The volume and the shortening of the cycles is such that if you don't start employing AI, it's very difficult to be able to think about a much more compressed timeline for payments, for settlement, where are T+1, but in several markets where T+0, payments is instant payments. So there are a number of elements where the data, it's not only the data emergence and using the data, but it's also correcting payments, extracting data, liquidity, and just having a good view of liquidity for all our clients at every moment in time. So we think it's key. We believe it's going to be deployed in a, I mean, you were saying 2-3 years. Yes, I absolutely believe that in 2-3 years, we're going to see a lot more being deployed. I do think it requires understanding and knowledge, and hence, we've started from, we want to ensure that our people understand and understand the risks as well, so that they can actually use it responsibly. So I think that's where we're taking this now. From our clients' point of view, I would say there is a variation of different institutions are very advanced in the utilization, particularly in the retail banking space, because of course, as was mentioned before, it's an easier element of repetitive tasks that you can just kind of augment, right? Chatbots and similar. But also in the institutional space, I'm seeing more utilization. But then you have also other institutions, very large ones, who are at the beginning of this path, and we're trying to exchange views and perspectives with them, and just kind of have some common approaches where possible.
I think that's simply fascinating. Central banks have, of course, different objectives from BNY and from your clients. But this is a world which central banks, I think, will not be able to ignore in future. And this is the first report that OMFIF have done, which actually had a section on AI. It will by a long way not be the last. One question which arises, and I throw this to the panel, is reserves, policy reserves are there to be used. And you can only use them in markets. And if markets are being driven by other people using AI, it will change those markets. Maybe they react faster. Maybe you get more flash crashes. Maybe you get more program trading, whatever. So I don't think central banks can fully stand back and say, we'll make slight use of it in our data analysis. I think it fundamentally changes the world in which central banks operate in. Does anybody wish to comment on that? Gunther, you are now working in markets where other people are using AI. Can you not?
Definitely not. No, because in markets in general, and I think that's true for not only AI, but in general, everything fits together. So we have the spillover effects from private markets, even if we are not invested there. We have effects on what's driving the markets in areas, in regions of the world we are not invested in. And the same is true for technology. You can't avoid it. You can't ignore it. And of course, if price discovery is happening with AI tools, and couple of years ago, people had to read their conference call transcripts. Now AI is doing it, and you get the summary within seconds. Things are much, much faster, and therefore you can't ignore and do as you've used to a couple of years ago, of course.
Guillaume, your views. Can central banks stay analog in a digital AI world?
So definitely the answer is that we have to adapt to this new reality, right? So but we don't have to be too pessimistic. Could bring more efficiency, right? To get rid of some human bias, which is also prone to trigger crisis. So it's not one-sided, I would say.
And Andres, any views on it? I do think this is probably the most interesting area to come out of the report because it's the least expected. We come back to what did we find surprising?
Yes, and I'd say to a particular point of trading, definitely it affects pricing, timing, and even liquidity, which is an issue that the survey also addresses. I think it's important to keep it and work on it because it is affecting markets. So So when you trade large volumes and you always expect liquidity in treasuries and as such, but it still affects it. So it's very relevant.
Portfolio construction, portfolio trading by AI, this has been a challenge in the past and has led to market fragility, not least because markets tend to then become totally homogeneous. Everybody using the same AI will have exactly the same positions and will be trying to exit them at exactly the same time.
Yes, and I think that's maybe a point where being conservative actually helps. Any decision has to have a human at the end, and not based it on AI. You can see you hear these stories about markets misbehaving because of models executing trades. So it makes sense to be conservative, and that's why maybe we are also have that perspective.
Patricia, you said that this was a topic which Bank of Uganda is looking at closely. What came out from the report for you?
Well, what came out for me was we as central banks cannot ignore AI because we live, like you said, in such a dynamic world that's integrated. And like you said, everyone's going to be rushing out the door. You don't want to be the last and get the worst price. I also believe that AI is necessary to free central bankers' hands and minds to focus on real issues. So take everything that can be automated out of the picture so that just like private sector, central bankers can focus on real issues that require their minds. So it can no longer be ignored. And I think this is a muscle that we need to build.
We will see. We will hold this call in 3 years' time, and everybody will say, oh, yes, AI, of course. But right at the moment, I think it is an area where central
Yeah.
banks have a lot to learn, have great opportunity to benefit, and I sense from this report are at the early stages of that journey. I don't know, Gunter, if that's how you see it.
Well, I'm somewhat I'm really curious how fast it will emerge, because often in things like that you have rapid enthusiasm and afterwards a couple of decline and you have drawbacks and things like that. So right now we are really in the gold digging phase, also in the market value of AI producers, and let's see what problems will emerge in the future. So as a risk manager, in my opinion, I'm always a bit also I have a pessimistic view on it. I think we have not fully understand the possibilities, but I think also that there's right now maybe too much enthusiasm in it. But of course, we have to use it. We have to learn it. I always say to my people, the biggest risk is of losing out, being not part of it and don't understand it is much more riskier than try it and learn from it and with it.
Guillaume, how much can central banks play the observer here, and how much do they have to get involved?
So once again, so we're quite conservative. So if you mean FX reserves management, probably it would take some time. I suppose, right? I assume it would take some time. So we can talk in 3 years. Probably adaptation won't be that high, but for daily task, operational task, I mean, there is no question we will use it like any other private sector entities.
I think this is a good point to start our conclusions, and we've spent the last few moments talking about something which is very, very new and has the capacity to change so much, including reserves management, but I think more importantly, including the way central banks interact with markets. Can I turn now to sort of as a final thought for all of you, what in the report strikes you as the continuity? What, how would this report be received by reserves managers of 30 years ago, by perhaps reserves managers of 15 years' time? What are the constants in central bank reserves management? Patricia, would you like to start on that one?
Yes, please.
You've gone mute, I'm sorry to say.
Sorry about that. Is that
Better.
all right? Good. Thank you. That's interesting. What would a central banker from 30 years back, a reserve manager, think about this? Well, they would be very happy that safety, liquidity, and return are still ruling. What changes is the how and what is driving those factors right now. The geopolitics I know has been around, and it is a matter of time, and the cycles keep changing. The strength of the dollar is still a constant, but the undertones are quite interesting, and really we await to see what is going to come out of that. What I found really interesting was I thought the ESG had picked up among other central banks much more than came out. I thought it was stronger with other central banks, but what turned out was actually very much like us, other central bankers are still focused on the three objectives and then ESG. So that was interesting. Gold is stronger than ever. So it gave us comfort that yes, we are on the right path. Need to be careful about the volatility, but indeed it is an interesting asset. So very much alike and a few differences, but yes, that's it. Thank you.
Thank you. Andres, your thoughts. What would your predecessors say, and what will your successors think?
I would agree that on the fact that the aspect that the three pillars remain solid and we still expect them to be the highlight for them and maybe the positive point. And I would say that they would be surprised by two things. First of all, geopolitics and the importance that it has today on markets and our portfolios. There's this funny thing that if you go to a conference nowadays, you see 3 or 4 sessions on geopolitics and maybe 1 or 2 on economic outlook. I'd say that 10, 15 years ago, that was totally different. It would be mostly based on fundamentals and economics in terms of investing in reserves. And nowadays, you have to have a closer look at geopolitics. And the second aspect that I'd say that maybe surprises him is the fact that we are now talking about the supremacy of the US dollar as a reserve currency and the fact that we are looking for alternatives to diversify. Maybe that 10, 15 years ago wasn't up in question. So I'd say that that's very illustrative of how we are nowadays.
Guillaume, your thoughts?
Quite a difficult question, right? Frankly, I would say hopefully the technology would help us to navigate through this complexity because the world doesn't seem more easy today than it was before, right? So quite, but even if the big picture hasn't changed much in terms of FX reserves, quite strangely.
Gunther?
Well, the main job of reserve managers didn't change over the years and over the decades. It's just to manage a large amount of money in a professional and responsible way. And therefore, the main topics, what is the role of gold? What is the main role of the dollar? What is the part of Europe and so on? They are quite persistent. But I really like the report because it gives a great summary of where we are right now in this ever-changing way of doing business. But the core business is, of course, it stays the same.
Adriana, you have the luxury of observing 4 central bankers and their responses. Your views, what is the constant? And what will our future successors say?
I think the constant are the objectives, right? It's the resiliency being core to the whole discussion. But we're moving, of course, from a bipolar world to a multipolar world, and this is visible. That's part of the discussion we're having. Geopolitics is back in every single CEO and exco level conversation and with the central banks. Of course, technology, this is not the first time that technology is changing the way things are being done. So this is yet another technology, probably one of those very big changes, but not that dissimilar to the Industrial Revolution back in time. So I think it's interesting to see how the technology is going to be implemented, utilized, but it doesn't change the fundamental element of how central banks are operating and why they're operating. So I think it's very interesting to see both what was 30 years ago today and possibly in 30 years, but the way things are being done is probably going to change.
Well, thank you all very much. I think my takeaway is that how reserves are managed can change. Why central banks have reserves is much more constant. And coming through the report, sometimes as an understatement, sometimes loud and clear, is this pursuit of stability in markets and the reserves as a tool to achieve the central bank's aims. Central banks don't hold reserves because they like reserves, because they love being asset managers. They hold reserves as a policy tool. It's a tool to enable them to achieve their wider objectives as a central bank. And that, I think, is the great constant. And we have discussed here the role of a dollar. We've discussed here the diversification, the currency diversifications. We've discussed as part of that the role of gold. And the report is very clear that people are looking with new eyes at gold, and they're looking with new eyes at acquiring more gold. So very interesting news which comes out. The strange asset that the more expensive it gets, the more people want to buy it. We discussed asset allocation. We discussed the tiering of strategies. We touched on the use of and the importance given to ESG, and different central banks are working out in different ways, both whether that's important and how to implement it, how to reflect the priority they've placed on it. The report and our discussion has spent perhaps the most interesting part was where does technology take us? And in particular, where does AI take us? And central banks here reflecting the fact that we cannot ignore the outside world. The outside world is going to use AI, as Adriana said. Bank of New York already is. Many of your clients are. Central banks do not exist in isolation, cannot cut themselves off from trends in markets, trends in the global economy, particularly trends. I think AI is one of the biggest trends we've seen. And I know here at OMFIF, it's something which, right at the top of OMFIF, it's a considerable focus of attention. But behind all of that, behind all of the things we've discussed and the way that reserves are being managed and the way that central banks are carrying out their reserves management duties, we come back to the fundamental, which is the reason that central banks have reserves, is that it enables them to better carry out their primary objective. And that primary objective remains, as it has, I think, for a very long time, stability of markets, stability of economies. And above all, that is what comes out from me from the report. There are many ways of carrying out the responsibilities, but the end objectives of the central bank remains the same, remains the stability of markets, remains the resilience of markets, remains the resilience of economies. And that, I think, above all else, is what the central banking sector aims to deliver for the electorates that give it their authority. May I take this opportunity to thank my fellow panelists for, I think, a very wide-ranging discussion. I think a very open discussion. I thank you for the way you've approached it. And to say that, once again, to those listening online, that the report is available from OMFIF. And if anybody would like to see it, it's, as I say, only just over 30 pages long. So It's not one for your next intercontinental flight, but you might like to read it in your spare time. I think there is a lot in it. I have very much valued the analysis, the insights that my fellow panelists have brought to it. And I thank all those on the call for listening to us. Thank you and good afternoon.